Welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker with our guest Matt Williamson, who's one of our experts with the Fruit Fly Trade Alert Service. Before we get started, a quick disclosure: the Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And again, this is for educational purposes only. So with that, Matt, I'll stop sharing and give you the ball, and you should have it now. So it's been a while since you've been on the roundtable. It's nice to have you back and give everybody an update on the fruit fly and how it's going.
Thanks. Yeah. So, and Tom, I probably should have asked you this beforehand. Do you want me to, or would it make sense for me to sort of go through the strategy again, or give an update, or both?
Probably both. I mean, you might want to start with an update if it doesn't take too long, and then go through the strategy.
Okay. Yeah, sure. That makes sense. All right. Let's see. Share my screen. All right. Can you see my screen?
It's loading. Should be about there. Come on, Webex. It's still gray for me, like it's still trying to load. It normally doesn't take this long. Craig says it's great for him too.
Does have good space in there.
It does, doesn't it? Well, maybe try stop sharing and reshare it.
Okay.
It's always something, isn't it?
Yeah.
Oh, there we go. Now I see it.
Okay, great. Yeah. All right. Looks like everybody else can see it too. So yeah, just a quick update. We started in December and have done very well since then. So no losing months. I did not trade for a good portion of April. The French election had kind of a vol freeze effect on the market. So I don't know if you guys were trading during Brexit and pre-election, but the market makers have this new trick where they just sort of freeze time and volatility and make everyone sit on their trades, and nothing really happens. No profit comes in, no losses go out until after the binary event has passed. So the first round of that French election kind of was the binary event. It seems like all the vol came out after, but so April we didn't really do much. There was not much there, but so we've been averaging 2% per month. January was a good month. We hit 2 profit target trades that month, but so I was talking to someone else about this. The trade generally does fine on a kind of runaway bull market. I mean, we've had a pretty significant bullish market so far this year. So it's not the optimal market for the trade. The optimal market is sort of a stagnant, flat, choppy, maybe even drifting down a little bit or moving up, slowly with some corrections. The trade will do better in that environment, but it does fine in sort of a runaway bullish environment. I know that some other strategies suffer in that market environment. So, 2013 kind of market seems like what we're dealing with today. So it does fine in that market, but we are underperforming sort of the annual average based on the back test. But I think it's just the market environment we're in right now. But obviously doing fine, no trouble at all. Can't complain about 2 or 3% per month. So that is the sort of performance update. If you're interested in stats, let's see. View all the trades. Here's the whole trade list. So we took a small loser I think this was the French election first round binary. Ted, the target we seek is $200 per trade. Ted was asking what the profit target is, and I'll go through all that in the trade plan. Yeah, target's $200, so we've hit 1, 2, 3. I want to count this one here. Yes, these are all one lots. 4, 5, 6, 7 profit targets out of 2, 4, 6, 8, 10, 12, 14, 16, 17 trades. So about, a little less than half are hitting profit targets so far. Back-tested annual was about 60%. I'll go through a 10-year backtest in a minute when we're doing the trade plan. So there's the stats. Like I said, pretty good. So, all right, so let's dive into the trade plan for anyone who's not familiar with it. It is a broken wing butterfly trade, and let me just go back to the slides. Tom already did the disclaimer. Quickly about me, I've been trading about 7 years option-wise. I've been investing for longer than that. Went through a number of sort of losing phases and settled nicely into butterfly trading, which has been the most profitable. And at this point, I enjoy kind of creating strategies and coming up with trade plans and trying to mix this trade and that trade and see what kind of wacky stuff I can come up with. So the fruit fly was sort of my first attempt at creating a trade plan. The quick background on it, I came up with it based on the road trip trade, which Tom and Dan do a wonderful job with their alert service trading. I know they're doing some different things with it now than they were when the trade was initially designed, I think. But so when it initially came to be, I think it was around the 70 days to expiration kind of trade, and for me that was just too. It was too slow. Like I was too ADD or something to sit on a 70 days to expiration trade. I've surpassed that hurdle now and do some longer dating trading, but let's see, DG, I'll come back to that question too. I'll check the chat in a minute and kind of circle back. So so I tried to cut it down to about 30 days in the trade, just so that I could have a little more excitement, which is certainly not necessary to be successful trading, but for my psychology, I just want something a little more exciting. So I brought the days to expiration down to 40, and have since brought it down to 30 since then. And then the second thing I noticed was that when I brought the DCE down to 40, the entry target on the road trip trade originally was $1.25. I'm not sure what it is now, but I could never get that $1.25 at 40 days to expiration. So what I decided to do was to spread the wings out a little bit. So instead of doing a 40-point upper wing on the butterfly and a 50-point lower wing, I spread it out to 40-point upper and 60-point lower. And by lowering that long leg, I was able to get the entry price to basically sort of match the road trip. I was taking on twice the risk, so my risk was $2,000 instead of $1,000 here. So, but I was able to get the trade on for $250 instead of $125. So I was thinking of it as doing a 2-lot road trip, paying double the amount, taking double the risk, but bringing the trade in time to collect the profits quicker. And the last thing was basically just I needed a mechanical trade. At that time, I was doing much better with a fixed set of rules that I could just follow. I've since started doing a little more discretional trading and finding that to be successful for me. But at the time, I really did not have the psychological chops or the trading chops to feel comfortable doing discretional trading. So, and then I have the slide in here that I know I mentioned it before, but I don't want to take anything away from the road trip. It's fantastic. The guys do a wonderful job with it. So Tom and Dan, I don't think Dan's probably on the call, but Tom,
I don't think so.
I applaud you guys. You're doing a fantastic job. So
Thanks.
So it's just a different trade. It's a quicker trade. The setup is kind of similar, but all the management I think is different. Here's some important metrics, and this may be a good idea to let me close my Slack. This may be a good idea to close Skype also, so things don't pop up. To go ahead and visit that back test and maybe answer a few questions I know there were a couple that came in. So let's do that. Okay, so here's the yield on the 10-year back test, and let me just go over these questions really quickly.
Okay, answer the one about the yields.
Okay. Oh, gotcha. Okay. So yeah, everything in the back test is a one lot. This is no compounding, so it's just going in and out with one lot at a time. The planned capital on the SPX trade is $4,000. Profit target is 200, so that's 5% target. There is a max loss. There's a max loss that's based on the structure, so we'll talk about that as we get in there. So there's no fixed max loss number, but you can see the average loss was about $400 or so. Average gain 185, so give or take double the average gain. Please distinguish yield on account and yield on planned capital. Are they different? Yield shown.
Yeah, I can answer that.
Okay, yeah. So yeah, it's a $10,000 sample account. I'm running 2 trades. I'm using 80% of the margin at any given time, so the yield on account should be slightly lower. Cool. Yeah, the yield on each trade and the yield on accounts and the yield on margin use would all be slightly different. Cool. So trade struggled a little bit in 2014. It was just a little too choppy. The trade worked fine over 2015. You can see a little blip here from August and September as volatility increased, and then from then on out it did fine. Throughout the bullish market from 2013 to 14 it did fine. 2012 fine. 11 was kind of turbulent in the summer, and then during 2008 obviously it did take a hit. It can handle pretty good down moves, but a 2008 magnitude move is going to be a challenge for it. It does expand depending on volatility. So if you are, if the VIX is at 40, VIX at 40. Let's say the VIX is at 20. That's like a full-on crash these days. Then the wings will expand a little bit. So instead of it being a 40-point, 60-point wing, it might be a 45, 65, or even a 50, 70 or something. So the whole butterfly gets a little wider, so it can handle more movement to the downside. So it does adjust for volatility somewhat automatically with the setup. Okay, so let's go back to this guy here. Weekly or bi-weekly, basically tracing and placing a trade every 2 weeks or so. Yeah, the average, I have it in here. Average time in trades a couple of weeks. Sometimes they go shorter, sometimes they go longer. But yeah, basically every time I close one, I'm opening another. With the alert service, I've been overlapping Russell and SPX trades, kind of trying to stagger the entry just to get a little time diversification in addition to underlying diversification. So if I have an SPX trade on, I'll try to let it sit for a few days and then open the Russell position. And, try to get them set up so that they're kind of working to hedge each other a little bit. But typically indices move more or less in step, although lately it's been kind of wacky. We're using for money management. What is the loss to exit? We will cover that in a moment once we get to the setup and trade plan. So this is 2012 to 2016. I need to update the slide for 2007 to 2011. Yes, I opened the trade immediately without regard to volatility or skew. So no, I didn't use any hedging in any of these tests. I do hedge the trade sometimes in the alert service. So we're not going to get into the hedging. I usually use a few different options to hedge, but it's kind of a discretionary portion, so it's hard to write up rules on when to hedge what. So if the trade winds up being overly bullish, I might hedge the downside a little bit. So I've probably done that maybe 4 or 5 out of those 17 trades. So the setup is SPX. Again, we've been using the Russell also. Days expiration 30 to 35. This can go down to, really as low as maybe like 14 or so if the volatility is crazy high. But it can go down 20, 25 if you're in higher vol or you have a big down day. and sometimes I'll go up, 37 or 40 if volatility is really low and pricing just stinks. No conditions, it's always in the market, although I did take off those couple weeks for the French election. So the way we open the trade, we just buy to open a broken wing butterfly with the upper wing at the money. Sometimes I do 5 points in the money. Sometimes I'll do 5 points out of the money if I have a particularly bearish bias. But it's set up, so usually I'm wrong with my bias. So if I do set the trade up slightly out of the money, it's still got enough room to do fine if and when I'm wrong. So the overall wing width, so distance between the top long strike and the bottom long strike should be no less than 80. So that would be a 30-point upper wing, 50-point lower wing. I wouldn't go any narrower than that. I like it to be 100 plus, but it's just not. It's not possible with volatility where it is. So the lower wing width minus the upper wing width should be 20. So if you're doing a 40-point debit spread, then you would want to do a 60-point, 60-wide credit spread. If you're doing an 80-wide debit spread, then you'd want to do a 100-wide credit spread. 30-wide debit spread, 50-wide credit spread. So just make sure the difference between the two is 20. So in low vol, you would go close to 40 days to expiration. Yes. In lower vol, I'll push out. I'll either narrow the fly or I'll push out the time, and we'll talk about these two in the next slide here. So when we enter, I'm sorry, the entry price should be less than 250 per fly. So if you're paying more than 250, it's too much. You're going to wind up struggling to the upside at more than 250. And you can certainly shrink it so much that you can put it on for credit, but then it turns into a more bullish trade. So if you want to keep it neutral, try and shoot for a couple dollars. Jeff, not an iron butterfly. I just do it all on the put side. You could do it with calls and puts. It shouldn't make any difference. Upon entering, we will note the starting theta value at the current price. So I just use the standard IIV model and toss the individual implied volatility, no vol surface if you're using OptionNet Explorer. And what is it in option view? I think it's the I call it the old McDonald Greeks model. It's like EIEIO or EIOIE or something.
Sounds right.
Yeah, just use the very standard sort of non-optimized Greek model. And just take a look at your theta and round it down to the nearest multiple of your lot size. So if you're doing a 1 lot, just round it down to the nearest whole number. If you're doing an 8 lot, you would round down to the nearest multiple of 8. And you're going to use that theta number as your threshold for upside adjustments. Okay, and it'll make more sense as we go through an example. Okay, so let's say we're trying to put the trade on. We go out to 30 days to expiration. We set up our 40-point debit spread, 60-point credit spread, and the price is too high. So if you need to bring that price down so that it fits the $2.50 criteria for opening, you can keep the strikes the same and push the trade further out in time. So instead of 30 days, you might go out to 35 days or 40 days or even 50 days or 60 days. Volatility is probably like 9 if you're going out to 60 days. You can also keep the days to expiration the same, but shrink the spread, and just be sure to keep the difference between the wings to 20, or your margin requirements are going to change. Or you can just wait. If you wait for volatility to come into the market, good luck with that these days. You might have to wait for a VIX spike to 12 or something. But if you wait, obviously there's opportunity costs that you're taking. So. All right, so once you get the trade on, and it's going to look something like, just find an entry here, 25th of May. All right, so your entry might look something like, maybe I can find the entry time. Sorry. Oh, it was on the 24th of May the whole time. No wonder. Okay. There we go. All right. So your entry might look something like this. So this would be a 2060 to 2020. So a 40-point upper wing. So 2060 with the upper long, 2020 is the short. and then 2020 to 1960 is a 60-point credit spread. So it should look something like this. Basically, when you set it up, you'll generally be delta neutral, and then we would want to mark the theta value. So this is a 1 lot, so I would just be using 12 as my adjustment point. So as the market moves up, if the market moves this way, you'll see you can watch the little box down here. The theta will fall off pretty quickly. So basically what we're going to do on the upside to adjust is once theta drops below 12, we will take our short strikes you would take these 2 short strikes, the 2020s, and you would roll them forward. So you buy to close one of them and roll and sell to open a strike higher up, which will do 2 things. It'll raise your upper expiration line and lower your lower expiration line. So sort of helping the upside, hurting the downside. With the idea being, as the market moves up, we're sort of converting the trade into more of a bullish position. So we can go through an example in a minute, but that's the idea. So as we move up, we'll watch the theta, and if the theta drops below 12, that's the adjustment we would make. We'll also watch the delta. As the trade progresses, the delta is going to get more and more negative because it has to pull the T plus 0 up to this level in the next 30 days. So the delta over here is going to get more and more negative. So if the delta gets more negative than 5, so it's a confusing sentence, but if the number here is greater than 5, the absolute value is greater than 5, then we'll do the same adjustment. We'll take the shorts and we'll roll them up. Okay. Anybody have any questions about the trade so far?
Doesn't look like it.
Good. Okay. After we do that adjustment, and maybe this would make more sense. Let me look at the trade log and see if this has any adjustments in it. You start this with positive delta. I typically start it with flat delta. So I mean, I'd call this flat. 24. Let's see what happened on 524. Okay, cool. Yeah, so here's a good example. So if we ignore today's trades for a second. So we made it to here, right? And theta went from 12 down to 9. So we've got to do something. So we'll take those short strikes and start moving them up. And if we move up half of our shorts, 10 points, it doesn't quite get us there. So we could take all of our shorts off, move half up 5 points, half up 10 points, and that gets us back over our theta threshold. And I believe that's what I did. So if I do this, yep. So there's the adjustment. And in this position, is there an adjustment on the downside? There's no adjustment on the downside, Jeff. And that's my next slide over here. The exit point is if we hit this right here. Zoom in. If we get to where the T0 crosses the expiration line, I only check this once a day, so if I check it at my once a day point and we're anywhere over here, anywhere to the left of this cross here, that's our downside exit point. So it gives the market pretty good amount of room to breathe and kind of fluctuate in here, but certainly possible to take an exit. The other thing is that when volatility kicks up, the T0 flattens out. So even if you're pretty close to expiration, if you're over here where this line's starting to really kind of die off, when volatility kicks up, it flattens it right back out. So it actually sort of helps your loss on the way out, if that makes sense. So that's the adjustment you make on the upside. And then if we happen to reverse and whipsaw and land back below this upper long strike, what I had been doing in the past was to reverse the adjustment. So we would just go back and basically reset the trade to what it was before. But I found out recently that it actually makes more sense to go take the lower long and roll it up. So it's not giving us a much closer exit points. Our exit points, basically just a few points from where it was before, but it helps the upside remain intact a lot better. So that's my sort of standard go-to adjustment if we close back inside the structure after we've made that upside adjustment. And we will do that upside adjustment as many times as it takes to sort of keep all our Greeks in check, but we won't go past rolling all the shorts up 2 strikes or 10 points. If we roll them up 10 points, that basically takes us up to our max margin where we can't roll anymore. So once we do that, we are done. And if we get any more, if we run out of theta at this point, we just close down the trade. So I think I have examples as we go through. So again, if theta falls below that rounded starting theta value, we'll roll the shorts up by no more than 10 points to bring the theta back over the threshold. That's what I just mentioned about rolling all the shorts up 10 points. We'll max out your planned capital. And then if price later closes below the upper long, as we were just talking about, I'm going to amend the slide here. So instead of reversing the adjustment, we're going to roll in the lower longs. If we do roll in those lower longs, we're going to sort of reset our theta threshold. So let's say we needed to reverse this adjustment. Let me see what, I think the next day is just a closing order. Yeah. So let's say for a minute we made it back down here. Do this. I always do this on accident. Now I can't do it when I want to. Theoretical price. So let's put our theoretical price at 2050. All right, so at 2050, let's say we closed, and now we're back below our upper long strike here. So instead of reversing this adjustment, I would just take the lower long and roll it in. And then I would go and look 5 points above this upper long strike to 2065. And I would use that theta value as the new theta value. So that's 8.07 or so. So I would now reset my theta trigger to 8 instead of 12. That's kind of probably the most confusing part of the trade is when you do have that whipsaw reversal, sort of what you're doing and what your new theta trigger is. But again, once you close back in the structure after adjusting to the upside, once you close back in here, roll the lower long in and reset your theta trigger to 5 points over the upper long. And if you have questions about that, just throw them in the chat. I'll try and address them again. So, cool. The other thing is delta becomes greater than -5 to the upside. Roll do the same adjustment. Roll the short strikes up to fix your delta. And generally, if I do that adjustment, if the delta is too great up here, but theta is fine, and I roll the shorts to fix the delta, and then we close back in the structure, I won't roll in the lower long, just because Greeks are usually fine at that point. Oops. Okay, downside management, none. Woohoo. So exits, if you hit your profit target, you're out. If a T plus 0 is below the expiration line, meaning to the left of the expiration line, as we talked about over here, that is our exit. And if an adjustment would exceed your planned capital, that's also an exit. That's usually happening, if we make this trade. In fact, I can probably show you. So you go forward another day, and our theta is back under 12. Remember, for this trade, our original theta was 12. And if we make that adjustment, it doesn't get us to 12, and we're at our max margin, so we can't adjust anymore without busting our margin. So that would be our exit point also. In this case, it's not a profit target exit, but halfway to profit target in 2 days is pretty solid. So that would be the other exit point. Last but not least, if you're not sure what to do in a given situation, exit and review your trade plan. Unless you feel comfortable enough trading discretionally. I've got to that point, but it took me a long time to get there. So as a general rule, if I have no idea what I'm going to do, it's a good idea to get out for me. Okay, so some sample trades really quickly. Does anybody have any questions before we dive into sample trades?
I think you've covered them all so far.
Excellent. Okay. So a very bullish market, 7, 12, 13, similar market environment to what we're in now. So SPX price 1675. So I had to shrink the wings down to 3050. In fact, I think it probably makes more sense just to go through the process. So let me go back to 7, 12, 13. And I'll just do it in the sim later. What did I say? 7, 12. All right. So yeah, so the way I would look to set it up is I might check 28 days. It's always preferable to get to, oh, it's not always preferable. I prefer to do the shorter dated trades just because it's usually a little faster trade cycle. So I would go probably 1680 or 1670. Let's see, I think we're going higher, so I'm going to go 1680, slightly in the money. And then I'll try a 40-point wing to start with, so I'll put the shorts at 1640, and then a 60-point debit spread. That puts me down at 1580. So if you're not familiar with Option Explorer, here is the cost of your entry here. So $6.30, which is way over the threshold. So our threshold is $2.50. So I can either move this out in time. So let's just do that as a quick example. See what difference it makes. Okay, so we went from 630 down to 475, so pretty significant difference. So if I wanted to get it cheaper, I'd have to go all the way out to 70 days. So let's just see. I wouldn't actually set it up like this, but just to show you how to tweak price in your favor. So you go all the way out to 70 days, and now your trade price is down to $1.40. So you could do that. I'm going to opt instead to take the trade and shrink it. So that was our trade for 475. It's too expensive, so I will take the 4060 and we'll change it to 35 on the credit side, 55 on the debit side. So we still have our 20-point difference of 55 and 35. And now we brought the price down to 295, which is closer to the 250 target, but not quite there yet. So we'll bring it in one more time. So now we are at 30 points, 1680, 1650, and 50 points, 1650 to 1600. And now we've got our entry target, right? We're under 250, so. And our starting theta here is 9.23. I'm doing a one lot, so I'm going to round it down. Actually, I'm going to do a 10 lot for a second, just so I can talk about a couple of other things related to trading it in larger size. Okay, so theta is 92.30. So my theta trigger is not going to be 92. I'm going to go down to the lowest multiple of 10. So my theta trigger would be 90 in this case. Okay, there we go. So this does have a little bit of a bullish tint to it. I'm okay with that. Like I said, my market bias at present is bullish. Looks like we're breaking out of this last pivot high here. But I'm usually wrong about such things. Let's see. So I'm just going to go forward in time, and if this drops below 90, I will take some action. Or if this delta winds up going below or from an absolute value perspective above 50, above negative 50, I'll take some action. So we go forward, and everything looks fine. Everything still looks fine. And if anybody has any questions, just pop up with a chat. I'm keeping an eye on the corner there. Cool. So this day we've gone below our 90. So we're going to take our center strikes. And someone asked me at one point, you know, can I just take 3 of these and move them up? You know, or let's see, if I do this, it gets me back above 90, right? But if you try to close an order and put in 10, 3, 17, and 10, that's going to be like no market makers don't want to take that order. So I've taken to just doing half. So I'll take 10 of these strikes and move them up, and that's my adjustment. All right, 10, 10, 10, and 10. The market maker will be happy to have that order. You're not going to have trouble getting that filled. So that's going to be my adjustment. I'll make that adjustment. That gets me back over 90 on that theta. And we keep on going. Everything still looks good. So I am back below 90. My profit target's 200 per lot here. This is 176 per lot. So I'm getting close. I'm not quite there yet. So I'll make that same adjustment again, which puts me back over 90. And bullishly tinted again. Looks like I was right. Everything still looks good. We're still looking to stay over 90. And if we do fall back under this strike, we'll look to roll in that lower long. But looks like it's not going to happen, and we hit our profit target, so we are out. And then now you have a nice, easy order to close. You can close a butterfly. You don't have to do anything wacky. As long as you move half the strikes at a time, you're always going to be closing a condor or a butterfly. It won't be a 5-leg order. It won't be anything wacky. So, anybody have any questions about that trade cycle?
Doesn't look like it.
I don't know what that trade is. Doesn't look very exciting. All right, let's go to trade 2. I think I got shopped around on this one a little bit, which will be a good example. If so, yeah. Okay, let's go with that one. So we can talk about the reversal adjustment through 1914. Traded this strategy in any kind of size. Small size. I know people have done it in 20 lots, but I've never tried it in a 100 lot or anything like that. Okay, sure. All right, so we'll go to 30 days, and we'll see if we can set it up 30 days. Let's see what we get. 1870. I'd be pretty neutral here, so I'd probably just go right half the money. And I'll try 40 points and 60 points. And that fly is $435. Still too expensive, so I'm going to roll it in a little bit. So that's a 30-50. That's free to the upside, so maybe I should go back and do 35 points and 55 points. Oops, no, I didn't do everything. 35, 80. Oh, I guess maybe I didn't do the other one there. Try that one more time. There we go. Okay. All right, so the 30-50 spread is giving me the right balance. Why is planned capital different from account size? DG, I'm going to need you to elaborate on your question about account size.
I think the difference is planned capital is per trade. So if you got 2 trades going on plus margin, then the planned capital would be like $4,000 per trade on a $10,000 account.
Yeah, if you're looking at the performance, it's a $10,000 account so that I can run 2 trades simultaneously and just have a little bit of buffer in case I go over margin for some reason. So, all right, so here's our entry. Looks like our theta trigger will be 9. Just going to do another 10 lot. So 90 on the theta trigger. Okay, so first day in the trade, we're already under 90, so we'll take our shorts and we'll roll them. Looks like we got to roll them all the way up, and I'd be fine with that. It's close enough for me. So this is pretty bullish. In the alert service, I'd probably go ahead and hedge this. There's a number of ways we can hedge it, but I probably hedge it. It's a little too bullish for my liking, but we'll let it play out in this case. See what happens. Okay, cool. So we immediately reverse back into our structure. So this is a good example of what we need to do. So in the original trade plan, I would take these 10 strikes and just roll them right back and reset the trade. All right, but in my new wisdom, I'm going to take these lower 10 and move them up. So let's just do a quick comparison if I can. Yeah, let's do this. So ordinarily I would have done this. Commit that. But let's do, oops. No. Let's do that and then compare the two. Yeah. So my new proposed adjustment is this. So green line is what I'll be doing now. Blue line is what I would have done before. So I'd be scared of 3%. Yes, the 3 to 4% down move will knock you out of the trade. Yep. Doesn't, if you look at how often that happens, it doesn't happen that often. So again, you can hedge this. I would hedge this in the alert service. I would hedge it against that 3 to 4% down move. So you're getting knocked out a little bit earlier, 1818 versus 1808. So you're losing 10 points of downside runway, but you're preserving your upside. So if you do get whipsawed around up in this area, then we're still going to make money on the upside. So let me take out that last adjustment. And what to use to hedge? Mark, I usually use, my sort of go-to is I'll usually go about half the DTE, take some of the credit that I have, and buy some debit spreads. Maybe something like that. Still give myself enough room to kind of make some profit here, and if we do get a big pullback, like a little, maybe something more like that. Just something where if we do get the big pullback that would knock us out, we're not taking on so much heat. And then if we don't get the pullback and we bounce around here for a while or we move up, then trade still does fine. So there's a couple other things we can do too. I mean, you can add teenies, you can do back spreads. There's a variety of things you can do, but again, it's more discretionary, situational, based on the trader. Like I said, I've done it 4 or 5 times. We did hedge. I hedged in both directions for the French election. I wound up putting on a very short-term strangle and got out of the trade. I think that was at $35 loss, but yeah, so it kind of depends on the situation. Okay, so in this scenario, we're rolling our rolling the long strikes, the lower long strikes up, and we'll take a look at our theta 5 points over our upper long here. So 1875 says 73, so 70 is what I would round down to. So 70 is going to be my new theta trigger to do any other adjustments. Okay, I think still look good. Still look fine. And I'd probably just go ahead and exit as long as that was a real number and attainable. It may not be. It's like that was a high. Yeah, so let's give it one more day here. Yeah, there you go. So that would be our exit point. So just to address the downside concerns, that's usually people's comment with the trade is if you exit the downside, you get right back in or evaluate the climate. Ray, if we get knocked out down here, it's usually a really good time to enter because volatility is elevated. You can typically jump back into the same expiration you just got out of and essentially roll the whole structure down and sometimes get a profit target trade or even 2 profit target trades out of that same cycle depending on market action. All you need is one good bounce and you're all the way at profit target. So what was that last question, DG? Are you time layering 2 trades all the time? Usually, although I'm not doing it so mechanically that it's week by week, sometimes both trades will hit profit target around the same time or get exit at the same time, and then I'll go in on one and go in on the next one a few days later. But I do try to do a little bit of time layering, but there's not a ton of you're not getting a ton of assistance from time layering in this case. I know with like the road trip, you have that profit hump that kind of builds behind your structure that kind of helps with new trades, but this whole structure is so close to the money that you don't get a lot of help from profit hump. By the time you get the profit hump, you're usually at profit target and taking the trade off. One thing I did look at maybe a year ago or so when I was designing the trade, I started looking at, instead of taking this trade off at profit target, I was looking at basically taking the trade. Let's see if I can remember what I was doing. Taking the trade off, but rolling down the lower long. So you're retaining, most of your profit potential here, 2305. You're giving up $200 in profit, and then you have a 15-day, hedge against, against disaster here. So you could leave that on, and just let it expire. Basically, it did help with smoothing out the equity curve in 2015 during that August crash. So that's an idea. I mean, there's a few ways you can do it. In every case, though, you're eating into your profit to buy a bearish trade of some kind. So if you're a perma bear, you're going to eat up a lot more of your profit hedging against the downside. And if you look at the market, I mean, statistically, I'd have to pull the statistics out of my ass here, but if you look at the market, it goes up 70% of the time or something. So if you're hedging 100% of the time against something that happens 30% of the time, you're sweeping water uphill there. It's a tough struggle to come out on top. But you get to sleep better at night, so I understand why people do that. I think that's probably the gist of it, the nuts and bolts of it. So yeah, let's take a few minutes and go for some questions.
I know you've been answering the questions as we go. I don't think there's any unanswered questions at this point.
Okay.
I did want to remind people that if you're interested in following Matt, the trade alert service is at this URL. If you scroll down to the bottom, you can just jump on a trial and check it out. But Matt's had pretty good performance, pretty consistent.
What future tweet has a trade performance? It actually does great. It's doing great in low vol. Lewis, let me pop open the chat box here.
Jeff asked for the long-term backtesting results.
Oh, you may have showed this, but what are the long-term backtesting results? Yep, let me go find it again. So 173 winners to 39 losers. Average winner to loser is about 1 to 2. So if you just do the expectancy math there, that's pretty solid. Win to loss 4.4 to 1. Profit factor 2.1. So this was about, so this is $4,000 planned capital. So about 410% or so over 10 years. Let's just divide that. I guess that's about 40% a year, give or take.
Yeah, that's non-compounded, right?
That's non-compounded. Important distinction. Thank you, Tom. What future tweaks are you considering? Nothing really. I mean, the trade is, operating solidly, and I don't see it. I don't see any reason why it shouldn't continue to do that. As I if I happen to come up with a better adjustment or, a reason to do something different, I'll do it. But I don't have anything in the pipeline to change this particular trade. And yeah, Lewis, it's doing fine in low vol. And actually, we had a little vol spike to, it was 14 or 15 recently, and the trade held up fine. Could you show the last conversion into a debit spread again, please? Please go to the theta and trigger an adjustment again. Why use a debit spread half the DTE? Oh boy, they came flooding in. Okay,
They sure did.
let me take them one at a time. All right, so can I show the last conversion to a debit spread again? Certainly. So here is the original trade. So you're basically closing out the whole trade, right? Closing all trades. Yeah, you're closing out the whole trade, but instead of closing the lower long, you're just going to close a strike 10 below the lower long, and what that's going to leave you with is 10 longs here and 10 shorts here. If you want it to be a more aggressive hedge, the strikes are really cheap down here, so you can pay another $100 and get $17,000 worth of protection instead of $12,000. And you can even go down here and have yourself a nice big, monstrous debit spread hedge down here. And I think when I did it, I just did it 10 points. So you get to keep most of your profit and have a nice hedge. So, but I would probably just give yourself a percent. So, say, well, let me rephrase it. I would give myself a percent. I would say I'm willing to give up, 10% of my profit or 20% of my profit for hedging purposes. So when I get here, if I know I have $200 per lot, I want to spend $20 on that debit spread. So 157 to 137 is a 20-cent debit spread. So that would be giving up 10% of your profit to buy a hedge.
Another idea, you could sell out 9 or instead of 10 and just leave yourself a long put.
That's true. Yeah, you're talking about doing like that.
Yep.
Yeah, it's a good idea too. I hadn't thought of that.
So that's a good black swan type of hedge.
Right. Yeah, if you really get a move down, you're going to clean up. Cool. Okay, so back to questions. Please go over the theta trigger and adjustment again. Let's see, Mark, can you clarify, are you talking about the theta trigger initially or the theta trigger when we've closed back inside the structure and we're moving stuff around and resetting a trigger? Why use a debit spread half the DTE or not the K2 fast protection? So Ted, the reason I go half the DTE, as you start approaching expiration on the main butterfly, so let me do this really quickly. So yeah, once you start approaching expiration, start getting all this charm that's hedging you. So I don't really need a hedge until, or I'm sorry, I don't need a hedge after, after like 7 days or so, I'm done with the hedge. Once I get 7 to 10 days to expiration, there's going to be so much profit in this tent that I don't need any hedging anymore. So hence the reason for half the DT. And it's cheaper too, so I don't eat up all my profit hedging. I don't have any option software right now besides Thinkorswim. So the question on OptionNet Explorer, is there an alternative, something like OptionView? Do you prefer OptionNet Explorer? I have OptionView and OptionNet Explorer, and 1,000 times yes, do I prefer OptionNet Explorer. And I don't think I can get in trouble for saying this, but
No.
It's not that. I'm going to make a recommendation, but it's not a trade recommendation. It's a recommendation that you back test, that you get some kind of back testing software. So I've taught guitar for a number of years, and it's the same with guitar. Like if you don't have a guitar at home, you're not going to get good at guitar. If you don't have a pool, you're not going to get any good at swimming. Right? Like if you don't go running, you're not going to be good at running. Like you have to practice this. This is a skill that requires practice. Like you can read 1,000 books about options trading, but until you make trades and learn how to adjust and do it, you're just not going to be very good at it. So having a tool where you can go and trade in heavily accelerated time is invaluable. So get something. Thinkorswim is a nightmare to try and do any kind of back testing with. It's just a joke. So something like OptionView or OptionNet Explorer. My preference is OptionNet Explorer because it's 1,000 times faster, easier, looks nicer, is more user friendly. I mean, just every pro goes to OptionNet Explorer. In your 10-year backtest, what entry criteria did you use? No entry criteria. If I got jettisoned out the back of the tent here, I just went right back in. The only kind of funky thing was back in 2007, 2008, we didn't have weekly options available, so it was either take a trade at 56 days or take a trade at 14 days sometimes, and I would just wait until the 56-day option got to about 37 days, and then I would go in. So I wasn't taking super long dated trades. Is 10-year 60% yield expectation on the total account or yield on planned capital? Everything is planned capital, so the 10-year was actually 410% or something. That would be on planned capital. So if you take your whole account and trade the whole thing with the fruit fly, which I don't recommend doing, then you would have seen that yield on your whole account. But yeah, it's just the planned capital amount. For managing these trades, you need to monitor throughout market hours. No, I check these once a day for 5 minutes. So I usually check 30 minutes before the close. That's my checkpoint. There's a spelling error on your sign-up page. Ready to subscribe.
Oh,
Thank
I
you,
better
Tom.
fix that one.
Thank you, Tom. Both. Okay, Mark, that was your answer to the prior question. Okay, so let me do the theta thing really quickly again. Then. This is entry 19th of March. All right, cool. So when we enter, let's see. Mark, I think, right? Yeah, Mark. Yeah, so Mark, when we enter, we're looking at the theta number down here for the trade. You can also see it over here. So if this were a 1 lot, I would round down to the closest multiple of 1, which would be 94. As it so happens, it's a 10 lot, so I round down to the closest multiple of 10, which is 90. So basically, every day I'm going to look at the trade, and if theta is below 90, I'm going to take action. Like this day, oops, wrong box. So this day, before we made the adjustment, it was at 81. So I would roll the short strikes forward. Where are my short strikes? I would take these shorts, roll them forward with a vertical spread. So just moving some from 1840 to 1845. And if that gets me up to 90, good. If it doesn't get me up to 90, I can move them 10 points. And I can move all of those shorts if I need to. If I move all of them, obviously theta goes way high, the trade turns way bullish. So that is the adjustment. And then, so that's the adjustment we made. We took 10 shorts, moved them forward. And then when the market closes back inside the structure, I'm going to take the 10 lower longs. Oops, I already did it. I take these 10 and roll them up 10. And then I'm going to reset my theta trigger. So I'm going to go to the upper long strike here, 1870, and go up 5 points to 1875 and look at what the theta is there. It's 73. So I'm going to do that same rounding. I'm going to round down to 70 since we're in a 10 lot. And my new theta trigger for upside adjustments will be 70. Does that help, Mark? Yeah, thanks, guys. I've thought about calling it a pop fly. Fruit fly stuck, I guess. That looked like a good question about Vega. Usually if you have short Vega, it's preferable to have short delta to counter a big down move. In this case here, usually small long. Yeah, the flip side of that is your theta is so high typically that your if you do get a vol move, you're going to get hurt a little bit. But you're not in the trade very long, so if you can ride out the vol fluctuation, you're in pretty good shape. Neil, yes, it will be available for later viewing. It will be in the Capital Discussions library. Sorry, I tend to talk fast. Every time I watch a trading video, everyone on it is, saying, so now we'll take this short strike and we'll move it up 20 points. And I just can't do it. Like, I have to watch it on like 8 times speed to watch it. So I tend to talk fast. So I apologize for that. But yeah, it should be available for viewing in the library later on. That'll be on Tom. But Tom's on it. He'll get it done.
And somebody asked for the slides too, Matt. If you send me a copy or a PDF, I'll get that attached to the recording too.
Sure, I will send it to you. Send it to you now. All right, so thank you everyone for joining us, and yeah, we'd love to have you in the trade alert service. It's fun. Obviously, it's good for me. It's good for capital discussions.
Yeah, and there's the link again. Feel free to sign up and give it a try. Take a look.
All right, thanks a lot, Tom.
All right, thanks, Matt. Thanks, everyone. We will see you next time.